Today's highlights. Bitcoin's slow decline cools off, while the mining bull market is just self-hype. The White House crypto chief steps down and X quickly fills the spot. What's the hidden agenda? 33 trillion continues to skyrocket. Stablecoins are surging. How much longer can banks hold on? It's March 27th and it's Friday. Time to meet with you all again. This is BitcoinTV's Chinese channel, Where is the Coin Link? And I'm Lucia. First, let's look at the most important data headlines from the crypto world in the last 24 hours. The current market looks okay on the surface, but it actually feels like it's dropping. Bitcoin has been fluctuating between $68,400 and $70,800 over the past 24 hours. As of noon, Bitcoin dropped directly from $68,800 by nearly 3%, sliding down slowly from its peak. Ethereum, the runner-up, is even worse, ranging from $2,045 to $2,152, down 4.24%, clearly weaker than Bitcoin. The Ethereum to Bitcoin ratio is still being suppressed. Simply put, mainstream capital is still leaning toward Bitcoin. On-chain, things are actually quite interesting. Small transactions are rising, with the 30-day average nearing $95 million. This shows people rush in at any sign of volatility, but the problem is their share isn't growing, stuck around 0.7%. Basically, people are coming in, but it's all quick in and out trading with no long-term retention. This structure is very classic. It's like sentiment is moving, but the capital isn't settling. Retail investors are mostly doing short-term chasing of highs and selling of lows, rather than being long-term capital that keeps adding positions. So it looks busy, but the actual driving force for the entire market is still quite limited. The on-chain situation feels like the price is putting on a show while people are slowly exiting. Since August 2025, active Bitcoin addresses have been dropping from over 930,000 to over 650,000, a 30% decrease. Even the 7-day and 30-day averages are falling, indicating this isn't a short-term fluctuation, but an overall cooling down. In short, there are fewer people on-chain and capital flow has slowed, yet the price is still hovering. So this has created a very awkward situation. It looks like there's market activity, but in reality, the number of participants is decreasing. This structure usually means the market hasn't truly entered an expansion phase, as a real bull market should see both price and activity rise together. If activity doesn't pick up later, this wave is more like internal hype, and the real heat hasn't truly returned yet. The vibe in the mining circle lately is a bit sluggish. Miners are clearly not selling much of their coins anymore. This suggests the previous phase of forced liquidations is mostly over, and new market supply is starting to tighten. On the other hand, what's more exciting is that the hash rate is still surging, now nearing 1.2 EH per second. It's like it's getting harder to earn, while everyone is still caught in a crazy cycle of internal competition. So the problem is very real. Bitcoin's prices come down, but the costs are shooting straight up. The average mining cost is already approaching $80,000. Small miners are starting to struggle and are being phased out, while large mining firms are becoming more stable. Actually, this is somewhat similar to our business model. In the end, it's big fish eating small fish, with the small ones being swept away by this massive wave. So, in the short term, selling pressure decreases, giving the market a breather. But in the medium to long term, it might mean a few big players control the supply chain. The structure has already begun to change. Please like and hit the bell icon. We will monitor the news for you 24 hours a day. This channel is based on a macro perspective, helping you quickly grasp major changes in the digital asset field through 15 minutes of in-depth integration. Now let's look at today's news. What truly determines where the crypto industry goes in the next phase may no longer be as simple as policy, but rather who can truly control the gateway. On March 27th, David Sachs, the White House head of AI and crypto affairs, stepped down as his 130-day term as a special government employee came to an end. Key issues such as stablecoin legislation, the market structure bill, and strategic Bitcoin reserves are still being pushed forward. And on that same day, X recruited Benny Taylor, the design lead from Base, leading the outside world to reevaluate the potential of X money. One person left Washington while another entered the core of the platform. These two moves, when taken together, point to the same change. The next round of competition in the crypto industry is shifting from policymaking to product implementation. David Sachs's departure is ostensibly just the end of his term, but the void he leaves behind is significant. Stablecoin legislation, the Clarity Act, and strategic Bitcoin reserves remain unfinished. The White House has yet to announce a successor. This means the direction of US crypto policy hasn't changed, but the execution window has weakened in the short term, and the pace of legislative progress may slow down. Benji Taylor is no ordinary design talent. He worked on 0 to 1 products, founded the Web3 application family, and also led the design of Base. With such a resume entering X, the market naturally won't see it as just an interface upgrade, but rather as adding product capabilities like crypto wallets, on-chain payments, and even DeFi integration to X money. So what's truly worth watching in these two news stories isn't one person leaving or another joining, but that the center of power in the crypto industry is shifting. The most important question in the previous stage was whether regulation would loosen, while the more critical question in the next stage might be who can first integrate wallets, payments, transfers, and social features into a single product. David Sachs' departure suggests that progress at the policy level will still face some uncertainty. Benji Taylor joining X, on the other hand, shows that the platform level has already started to take the lead. For the White House, the question is whether the bill can continue to move forward, while for X, the question is whether they can turn X money into a true on-chain financial gateway. This is the greater commonality behind these two news stories. Next, let's look at a number, $33 trillion. What does this concept mean? This is actually the total on-chain settlement volume for global stablecoins in 2025. Can you believe it? It's already more than double the volume processed by Visa in the same period. More importantly, these funds aren't just circulating within exchanges, they're moving into cross-border remittances, payroll, daily spending, and microtransfers. In the past, many thought crypto payments needed regulatory approval, bank integration, and institutional backing before they could truly take off. But the reality is quite the opposite. It didn't first penetrate Wall Street's mature financial systems, but rather the high-fee, slow settlement scenarios long ignored by traditional banks. Now, stablecoins are moving from the fringes toward the center, and capital is clearly starting to congregate in this direction.
In terms of efficiency, stablecoins are no longer just a concept, they're starting to replace real-world payment scenarios. In 2025, on-chain settlement reached about $33 trillion, more than double Visa's $15 trillion. The cross-border gap is even clearer. SWIFT takes 3 to 5 days with 5 to 7% fees, while USDT settles in minutes for less than $1. So, stablecoins aren't capturing high-end users first, but those most sensitive to speed and cost. Simply put, it's not about being cooler, it's about whether it's actually usable.
We take care of 3 billion people that, by the way, these 3 billion people are considered a niche by the banking system. Many of our competitors say, oh, Tether is serving this niche of unbanked. Half of the population of the world should not be called a niche.
If stablecoin settlement volume shows that demand has risen, then capital flow is confirming the direction. Crypto payment firms raised $2.6 billion in 2025, exceeding the last 3 years combined, ranking third in crypto funding after infrastructure and exchanges. This shows the industry's focus shifting from issuing coins to building payment networks. Products like MyPay are discussed because they fill gaps in bank KYC and regional payments, entering where no one else is looking.
Technologies that truly change the payment landscape often don't start with core financial institutions, but grow from overlooked areas where real demand exists. For instance, Alipay didn't start at bank counters, nor did WeChat Pay start within the central bank system. Stablecoin payments are the same, appearing first in Argentine's daily choices to hedge against devaluation, in cheaper remittances for Southeast Asian workers, and in everyday scenarios for those avoiding tedious account setups. What's truly noteworthy isn't just the massive volume stablecoins reached this year, but that the products, networks, and capital surrounding them are all starting to converge in one place. While mainstream media still treats it as fringe news in the crypto market, the real alternative payment path may already be quietly unfolding at the base layer. Congress takes 5 steps to block insider info. Why is Nvidia's 8-year lie only being settled now? A major AI warning hits humanoid robots enter the White House. And why did chip stocks dive across the board? At BTV, we've covered crypto for over 6 years and seen so many people profit by knowing things first, like policy shifts, market secrets, or a company's real data. This used to be hard to prosecute because of regulatory gaps, on-chain anonymity, and the fact that information asymmetry was the norm. But today, these two news stories tell us that this logic is finally being broken. On one hand, the United States Congress is pushing legislation to block those profiting from insider info in prediction markets. On the other, a class action lawsuit against Nvidia for hiding its crypto mining revenue 8 years ago has been officially certified. The timing and industry positions differ, but the core narrative is exactly the same. In the crypto space, the I know something you don't card is becoming harder and harder to play.
Recently, Massachusetts Representative Seth Moulton ordered his staff not to take political positions on Polymarket or Kalshi, becoming the first in Congress to take action. The trigger was a series of outrageous trades. Someone bet on the Iran negotiations 14 minutes early and made $60 million. Others had a 93% accuracy rate predicting the situation in Iran. That same day, the PREDICT Act proposed expanding restrictions to the president, vice president, and political appointees. Within a week, Congress has pushed 5 proposals, and regulation is clearly starting to tighten.
When it is completely unregulated like this, you could have, vast amounts of insider trading, people who have particular insights either because they're government officials or because they're the athletes themselves who can end up influencing the events they're betting on.
The Nvidia situation is essentially a matter of information disclosure. During the 2017 to 2018 mining boom, the company stuffed over $1 billion in mining card sales into its gaming business. CEO Jensen Huang downplayed the mining dependence until November 2018, when CFO Colette Kress admitted demand had collapsed, causing the stock to plunge 28.5% in 2 days. The judge also cited internal emails proving that executives knew these claims were propping up the stock price. Now the class action lawsuit has officially entered the trial phase.
Today, Lucia is putting these two things together to see what signal is being sent behind the scenes. In the crypto industry, information privilege is actually being stripped away layer by layer. In prediction markets, profiting from job info on anonymous platforms was untraceable before, but now Congress is legislating to block it. And as for Nvidia, they were propping up their stock price with vague financial reports. In the past, people let it slide when a bull market came, but now, 8 years later, the courts are still coming for you. You'll find that, whether for individuals or companies, the cost of knowing the truth but choosing to stay silent is becoming higher and higher. For us, this is actually a good thing, because it'll be harder for the market to be dominated by that insider information. But for those players used to profiting from information gaps, this industry is becoming an increasingly difficult place to survive. This next set of news is very interesting. It's actually about a more fundamental change. AI is turning from a tool into an environment. So how should we understand this statement? It means it's no longer just a system you actively open to use, but it's quietly and subtly permeating our lives and the real world. For example, entering policy, education, and supply chains, even influencing the way we make judgments. You'll see that AI isn't just an efficiency tool, it's becoming embedded into the system of rules itself. Simply put, what's really worth watching isn't just AI's latest feature updates or new large models, but how it's rewriting the relationship between people and information, and how decisions are quietly being formed,
Recently, U.S. First Lady Melania Trump appeared with Figure AI's humanoid robot, Figure 3, at a White House Education Summit. This was part of the inaugural meeting of the Fostering the Future Together Global Coalition, covering 45 member nations. Figure 3 delivered remarks on site in multiple languages, including English, Spanish, Japanese, and French. Melania also outlined a vision for AI education, where a humanoid teacher named Plato could provide personalized, multidisciplinary instruction in literature, science, art, and philosophy at home.
It is an honor to be at Fostering the Future Together's Global Coalition inaugural meeting. I'm Figure 3, a humanoid built in the United States of America. I am grateful to be part of this historic movement to empower children with technology and education.
Google released the TurboQuant algorithm, which compresses the memory usage of large models by at least 6 times and boosts inference speed by up to 8 times, without affecting accuracy. Following the news, memory chip stocks fell collectively. HKEX dropped 6.23%, Samsung fell 4.71%, Micron dropped 3.4%, and SanDisk fell 3.5%. The market logic is straightforward. If the memory demand for AI inference is significantly compressed, data center procurement of HBM will be revised downward. On the same day, Karpathy pointed out on X that the fundamental problem with LLMs is recall, not reasoning. Popular answers in training data are repeatedly reinforced, causing models to increasingly favor mainstream answers over optimal ones. The personalized memory feature actually amplifies this bias.
If we put these three things together, you'll see they collectively sketch a true picture of AI's development. The boundaries of AI's capabilities are expanding rapidly, but every expansion creates new problems. For example, robots entering the White House marks AI's accelerated shift from the digital to the physical world. Google's algorithms compress memory needs, forcing a hardware supply chain reevaluation in this AI efficiency revolution. And Karpathy's warning is a more fundamental question as AI grows stronger. Is the answer it gives truly right for you, or just what most people accept? Having produced crypto content for years, I've increasingly felt AI's penetration into the information ecosystem. Understanding AI's limitations is just as important as understanding its capabilities.
Tether has officially hired KPMG for the first comprehensive audit of USDT reserves, while also bringing in PwC, aiming for regulatory backing to enter the US market. For 10 years, USDT has issued its own reports. Now they've finally brought in the big guns to audit the books. The market's reaction is that it's about time. BlackRock chairman Larry Fink stated in his annual letter to shareholders that tokenizing financial assets is like the internet in 1996. It won't change everything overnight, but it will slowly bridge the old and new systems. The world's largest asset manager comparing blockchain to the early internet carries significant weight. Blocktempo reports that 21.co has surpassed MARA to become the world's second largest public Bitcoin treasury. Companies aren't competing on performance right now. They're competing on who can hoard the most coins. HKEX stated that without returns for shareholders, they're in no rush for an IPO. Going public in a bear market is like streaking. Build up profits first before talking about ringing the bell. BN News, citing On-Chain Lens, reports a new wallet withdrew 340 BTC from Binance, worth about $23,140,000. Whales don't like to tweet. Their transfers are their statement.
In the past, the workplace was about execution. Whoever worked faster and did more was more likely to get ahead. But now, AI has elevated this field to a higher dimension because tasks like writing proposals, creating spreadsheets, and researching, which used to take a lot of time, can now be done in minutes. So the value of execution itself is being rapidly compressed. If you're still relying on diligence and hard work to build an advantage, you'll easily be wiped out by technology. What truly sets people apart now isn't doing more, but doing it right. Being able to judge the direction, break down problems, mobilize resources, and get things right the first time. In other words, execution is devaluing. Cognitive and decision-making abilities are the new barriers to entry. Remember, when execution is no longer scarce, thinking becomes the barrier. All right, that's the in-depth breakdown for this episode. Our channel has always focused on the core narratives and value discovery in the digital asset space. If you agree with our logic, feel free to stay updated with our latest news and turn on real-time notifications. To access a higher dimensional research space, you can follow our advanced channel. From Monday to Friday, we'll also share some personal, in-depth reviews of market cycles to capture certain opportunities within the trends. See you next time.